Welcome, Jason
Thank you.
Gill.
Thank you.
Thank you so much. Thank you so much for being with me today. Everybody, you got to know this guy is like a genius in this space of mortgages. I promise you, the knowledge, the wisdom, the expertise is invaluable, and I'm so grateful to have you in my circle and on my team. You know, part of my all of us realtors have to have a really tight team in order for us to facilitate the callings of our clients. So I just want to thank you and welcome you to real estate and mindset. You know, we got to deal with mindset. That's key.
Oh yeah.
And I'm just really grateful to have you on the show today. So thank you.
Well,
So
I'm
tell me,
excited. I appreciate you having me on.
oh yeah. So tell us who you are, what you do, how long have you been doing this? What brought you to where we're at today?
Yeah, it's been a journey. It's been 23 years, and I think this is my 23rd year. So as a loan officer, I started in Sacramento, and moved to Southern California. And I think it was maybe 2006. In San Diego was where I first landed, and been here ever since. Lived in San Diego, Orange County, LA. I live in Orange County now. I miss LA. It's my favorite of the three. I'm a foodie, so
Uh-oh.
I miss all the amazing restaurants there. But yeah, I run a team now here in Orange County, and we service primarily Southern California. I mean, throughout the state and some other states, but our primary market is Southern California. So yeah.
Nice. And so I want to get into, we've got a kind of an interesting market right now. And there's a lot of there's just a lot of narrative around it being kind of a negative thing, but these are the markets that I love. But let's talk a little bit about what you're seeing in the market, and over these past several months that things have started to shift. What are you seeing?
Yeah, it's interesting you say negative market or that mindset, because I think, today more than ever, especially in this topic, and real estate is a hot topic across the country now because of people moving from the West Coast to the East Coast, from California, relocating to Texas or Florida. All the markets, this is the topic. I mean, I go to the grocery store, I hear people working there talking about it. I go to a restaurant, et cetera. And, I think that negative, just that thought process, a lot of it comes from the media. I think there's just an influence
Absolutely.
more than ever, right? And you see that, like, even on CNBC, there's particular people that, oh, okay, well, the housing market's pulling back, values are dropping, but they're really spinning the data. If you really look at the data, not to say that there hasn't been price corrections, and I am seeing some of that in certain markets and certain price points, but the way it's being portrayed to the general public, first of all, some of this data is trailing information. A lot of it too is just being spun in a way that makes it sound negative to get a headline. But in reality, like you said, there's some opportunity, and now it has to be done the right way, right? Yeah. But there is opportunity, and so it's been interesting to see. I've seen what I'm seeing overall. Just to answer your question is, and let's talk primarily Southern California market, and I could touch on other markets too. But what's moving for sure still is lower price point. So 400, 500, 600, 7, 8, 9, depending on the area, it's just going, right? And that goes back to what the media has said. Oh, median home price across the country is dropping. But again, that's the skewed data, because on this topic of the lower price points moving, there's more volume and home sales taking place across the country at the lower price points, because interest rate rise obviously affects affordability slightly less payment wise, right? If your rate drops or jumps or drops half a point, you're not going to see as much of a change on a payment on a $200,000 loan as you will a $2 million loan, obviously. Right. And so the activity level has stayed, not to say where it was 2 years ago, but it's still stayed relevant, whereas the higher price points has slowed down. So of course, because of that, then it's just because more of the activity is happening at lower price points. That doesn't necessarily mean to the extent that the media is saying that prices are dropping. So in fact, I read information this morning that said that there was actually a slight price increase in the month of March. So, but we are seeing
Interesting.
yeah, right. And we're seeing a direct correlation. And one of my loan officers was talking to me about this a couple months ago, and I was like, I don't know if I agree. And he was saying, you know, it hasn't happened just one time. It's happening like clockwork now. When interest rates start to drop, our application volume definitely
Goes
picks
up.
up, right?
Okay.
And then
Yeah.
if we see a surge in rate again, then it starts to slow down. And we saw that
Interesting.
between January, February, and March in those 3 months.
Yeah.
And at first I was like, look, the consumer can't see the rate to the extent that we can on it. Literally, it's changing multiple times a day, right?
Yeah.
But I thought about it more, and he said, but you know, or he also pointed out, think about it now with Zillow and, you know, realtor.com and, you know, these rates pulling through, whether these rates are accurate for their scenario or not,
Yeah.
the fact of the matter is they can see on a daily basis a rate going up or down. And I think, you know, that's the, like you were saying, there's some opportunity, but I think the general mindset of the public is, oh, well, I'm going to hold off because rates are high, and, you know, I think prices are going to come down, and you know, and then they just stop right there. And you know, the challenge in that is, okay, if properties are already moving, imagine what's going to happen when rates drop. I mean,
Right.
right, the
Right.
inventory is already limited, right?
Yeah.
It's limited now, and that's what's keeping prices holding for the most part. And you know, when the rates drop, like late last year, there was a little dip and the rates had dropped to the mid fives. And
Yep.
clients were saying, look, lock me. How fast can you lock me? Please lock me. So what does that tell you? It tells you that the market has shown that when the rates get into a certain point, it's not going to stop people from proceeding. And when you have more competition and low inventory, it's going to make it more difficult for buyers in the coming months as inflation comes down and interest rates come down.
Yeah. You know what's interesting? I find it interesting when people say, you know, this is not a good time to buy, you know, and the rates are high, and but this is, I'd rather be not competing with other buyers and having to pay way over the list price. I'd rather be in a scenario where we have the opportunity to negotiate.
Absolutely.
And people don't, they look at this as being a negative and not a good time to buy, but this is actually the best time to buy, because now you have the opportunity to negotiate versus compete. I say, would you rather negotiate or would you like to compete? And it's just interesting psychologically how people tend to lean into the competitive mode and think that this other space is not a good space, you know. So I don't know. I actually got a call, interestingly enough, a mutual client of ours yesterday. I got a call. Actually, I got a text message from an agent who indicated that I had sold this property in 2018, and her clients are looking in the neighborhood. They want a house in that neighborhood. And she decided to go back to 2-3 years and see which homeowners might be interested in selling right now, because her buyers, there's no inventory. So they're looking to be in a very specific neighborhood. And they were really attracted to this home. So I thought, good for you that you stepped outside of the box, that you're thinking in a different way to go after properties that aren't even on the market, but had sold 2 or 3 years ago. Actually, 2018. What is that? 4 years now? Almost 5 years, I think.
5. I was going to say, yeah, coming up on 5. Yeah.
Yeah, coming up on
Depending
5.
on.
So here we are 5 years later. And of course, I picked up the phone to call our client. And it was interesting because they weren't thinking about selling, but now they're thinking about selling. So I spent like 2 hours giving them scenarios of, if you sell, this is what you could potentially net. But where do you want to go? and what does that look like? And it was a little interesting because what they've grown accustomed to as far as size and quality of area, that whatnot, they literally had to double their investment. So they went from a 1.3 now to a 2.3 neighborhood, right? But they're also bought for 1.3 and now they're selling for 2.3. And that's only in a 5-year period. So
Wow.
that's a phenomenal growth, you know.
Yeah.
I don't know how you dispute that you didn't do well, right?
Yeah.
But
Talk about timing.
yeah, talk about timing. And then, but of course, in their minds, it's like, but where do I go? You know, I'm sure you hear that a lot. You know, if we sell, where do I go? Now that brings me to, you guys have a very unique product right now, a bridge product. You want to tell us a little bit about that?
Yeah, the biggest challenge for everyone, right, is inventory. And so, we find, just like you said, there's a lot of current homeowners that are in a situation where, okay, I've got a great rate, most likely.
Yeah.
So that's a little bit of a deterrent based on where rates are at right now. But again, there's other things that could be done. But it's more a matter of, like you said, where would I go?
Yeah.
And a lot of the capital that they have is locked up in the equity of their property. And so the challenge becomes this whole, how do I buy before I sell? Or, because it's a little challenging to have your offer accepted when your offer is contingent upon the sale of your existing home. It's just another layer that has to be dealt with. So we have this bridge loan product where essentially a company will come in and assess a homeowner's property and ultimately just determine how much they would give them for the property. Just to keep it simple for that for now. And based on that analysis, they will then offer them a line of credit, which they will utilize, the borrower, the homeowner will utilize for the down payment on their next property. In addition, that same company will, after doing an inspection on the property, write a non-contingent offer. And so that means, obviously no loan contingency, no appraisal contingency, no inspection contingency. And a non-contingent offer is the critical piece to this bridge product, because for a conventional loan, the lending guidelines are clear that if you have a non-contingent offer on your home, even if you have not sold your home, meaning closed escrow on your home, as a lender, when I'm qualifying you for your next purchase, I do not need to count your existing mortgage payment against you, right? And that's been the big thing that stopped a lot of people, is they can't qualify for both payments. Some of them do have the money to put the next down payment without selling, but they can't qualify for both.
Yes.
And that's the big part that is different about this product. So now that, let's say your client, that homeowner, not only has the capital for the down payment from the line of credit from the company, but they also then have a non-contingent offer on their property, which then allows me to qualify them for only the new property that they're interested in.
Yeah.
Right.
So just so I understand, this particular company is able to give them a loan on the new property, and it can be a non-contingent offer on the new property.
So the loan on the new property would be structured by us. It would be a whole different lender, a new lender, a new loan. The company that's coming in is both putting an offer on their existing home to buy it, right? And at the same time, in the meantime, putting a line of credit on their existing home, which then gives them the money to put the down payment on the next property.
Wow.
Right.
Yeah, that's pretty cool.
Yeah.
So when they buy their current home, They buy their current home and then they give them a line of credit so they can put the down payment on the new property.
They actually give them a line of credit before they close escrow. They give them a line of credit. So they do their inspection on the home, which allows them to write the offer with no inspection contingency. So
Yeah.
then the homeowner signs the agreement, and they give them a line. The company gives the homeowner a line of credit to go buy their next house. At that point, they have 90 days to sell their home. So the
Okay.
offer from the company is kind of like a last resort. It's a guaranteed offer,
Yeah.
but you can still, you have 90 days to sell their home for them, their existing home.
Okay. Okay.
Right? So you've
Yeah.
got free reign to do your thing and do what you would normally do,
Mhm.
and sell the property in 90 days. And then at that point, if it doesn't sell in 90 days, then they come in with their guaranteed offer. But you could sell
Wow.
the property. Yeah. Mhm.
Wow. That's
Yeah.
pretty powerful.
Yeah.
Yeah. So what do you think? It's interesting because there's all these different things that are presenting themselves for opportunities for buyers and sellers. The motivating, I don't know, I guess in this environment that we're in, lenders are realizing that they've got to get creative, so to speak, in order to kind of bridge the hype or the what's the word I'm looking for? It's the media, it's the hype, it's you know the doom and gloom, if you would. So there's just all these different, what other kinds of products and things that are happening now? Are there any first home buyer programs still, or what are the various types of products that are available to folks out there?
Yeah. So all the different products, which I can go through a few, are really focused on the primary issue, right? And the primary issue is affordability for a buyer. And that affordability issue is due to, as we know, limited inventory, which is keeping prices where they're at for the most part, and
Yeah.
increased interest rates. And so, I think that this conversation of, what works, this goes back to what you and I focused on for our clients since the day we met, which is education.
Yeah.
And right, and it's going to be a different strategy. I love how you use that word all the time. Strategy and maybe loan products or options for different clients, whether they're self-employed, whether they're a W-2 borrower and they're $500,000 price point or a $1.5 million price point. But certainly, Fannie Mae and Freddie Mac and FHA for that matter, and even VA, all across the board, you're starting to see changes being made and to help facilitate the affordability issues, right? Whether that means that, Fannie Mae and Freddie Mac have said, okay, if you're a first-time home buyer, and which is defined in their eyes as someone who has not been on the title of a home or owned a home within the last 3 years. Okay, if you're a first-time home buyer, and depending on the area you live in, if your income is at a certain level of what's called the area median income level, then there are certain, let's say they're called loan level price adjustments. There are certain adjustments that determine interest rates that are removed. So there could be a substantial improvement in the rate in that circumstance for a particular home buyer, depending on, your income, where you live, which county you're in, et cetera. FHA recently reduced their mortgage insurance premiums, which obviously reduces the payment, makes things more affordable. Some buyers are then able to qualify at a little bit higher price point, or some stay at the same price point and have a more affordable payment. You've seen the VA do some things as well and lowering funding fees. So those are the types of things that are going on in terms of, for the first-time home buyers. Now, someone who's not a first-time home buyer, there's other affordability strategies that we're utilizing because, again, this client you mentioned that's a mutual client, okay, now they're jumping up into a different price point. And yes, they've got this amazing equity gain.
Yeah.
The no-brainer to potentially take advantage of, but they've still got to deal with financing at a higher rate in today's market. So,
Right.
we temporary affordability strategies. So that could be an interest-only loan, That could be a loan on a 40-year term. That could be a temporary interest rate buy down, what's called a 2-1 or 3-2-1 buy down, which
Yeah.
I can, right? So there's different strategies. Now, these are, I call them temporary affordability strategy because, you know, we're not suggesting that someone stay on an interest-only loan for the life of the loan and not pay the principal, right? We're not
Yeah.
saying finance that you know, to get into this price point, you should stay on a 40-year term because obviously you're going to pay more interest over the life of the loan if you stay in that loan. These are temporary affordability solutions until interest rates come back down, right? Which is already has been happening and will continue to happen. It's just a slower process. And then obviously the strategy is to refinance them into a, you know, fixed 30-year interest rate at a reasonable interest rate.
You know, I was just thinking of a question, and now that it just went out of my brain, of course. But speaking about these buy downs, let's talk a little bit about that, because there's a lot of buzz about this 2-1 buy down. Can you explain this program? Because I don't think everybody is really aware of, we hear the terminology, but what does it really look like?
Yeah, you know, so first of all, some of the newer agents have never heard of this, and because these type of strategies haven't been used in a very long time, and now they've been brought back to the market because of such the drastic rate increases in the last year that we've seen. And so essentially, whether it's a 3-2-1, a 2-1, or a 1-0 buy down, what it means is that the interest rate is temporarily reduced based on either the 3-year, 2-year, or just for 1 year, making for the first couple years, the property more affordable until rates come back down. So let me give you an example. So if the rate today is 6%, if the loan program that's being utilized is a 3-2-1 buy down, then that means in year 1, the interest rate would be 3%, right? And year 2, it would go to 4%. And then year 3, 5%. And then if you were still in the loan by that time, that same loan, at the end of the 3rd year, starting on the 4th, it would go back to the 6%. Now, again, I say if, because the strategy is that when interest rates drop, then let's say in year 2, you refinance. So let's just say the rate dropped from 6%, the market rate is 4.75. So you would borrower to the 4.75 rate, and now they don't have to worry back to 6.
Right. That's fantastic. Yeah.
Right.
And we're hearing that we can, what I've heard is that this is a strategy, and I haven't used this, and I'm surprised I haven't used it yet, but getting the seller to actually pay for that buy down.
Well, here's the beauty. This is the seller paid 2-1 buy down, because there are so many hybrid models of this now that lenders have gotten creative. It's not just seller paid, there's a lender paid, there's a hybrid model where you could do combination of seller and lender, right? But by far, the seller paid is the best, but because here's why. Let's say that, so what we do is on a 3-2-1 buy down, or any seller paid buy down, you give me the price point, I back into it with the amount of down payment the borrower is putting, and I then tell you, okay, based on X loan amount at X interest rate today, it's going to cost X amount of dollars to buy down the rate 3-2-1. Okay. So what's happening is when the seller is paying for this, so let's say I said it's, $19,000. Okay. So what's happening is the seller is subsidizing the payment difference, not the interest rate, the payment difference between, let's say, 3% and 6% in year 1. And then there's subsidized difference between 4% and 6% in year 2. And again, subsidizing the difference in year 3. So this $19,000 is the total quote unquote subsidy needed credit from the seller to cover this cost of the buy now over 3 years. Now, again, let's say we're in year 2 middle of the year. So 18 months has gone by. The
Yep.
buyer halfway through their program and rates drop. And we refinance whatever, 4.75. Well, all of the money that the seller provided at closing to subsidize the 3 years has not been utilized. That remaining money is the buyer's, the homeowner now, the new homeowner. It goes back to them. So if I refinance them, they don't get cash in hand. The lender will, let's say there's $10,000 left in the account. The $10,000 is knocked off of their balance on what they owe.
Wow.
So they don't lose it. Whereas if they use a 3-2-1 buy down from the lender, the money doesn't go back to them.
Okay.
Right.
Okay. Yeah.
So I think the reason that you see the 2-1 buy down right now in this market being used the most is because obviously the greater number of years you buy down the rate, the more it costs, the more money out of the seller's pocket. So the reality of it is more negotiations have been successful on the 2-1 because the seller's not giving up a, ton of money.
Yeah.
But it's still beneficial. And what's happening is, we're finally, homeowners in the beginning when this product came out, they wouldn't listen. They were still stuck in 21 and 2020. And this is a different market, right?
On all levels, they're stuck.
And it takes time, as you know, over the years, whether it's interest rate increases or homeowners being realistic on selling, it takes time for them to digest, whether they listen on the radio or the media, or they're listening to their agent, or they see their neighbor maybe dropping price, right? And so now that they're willing to listen, we go in advance and show them, look, if you sell your property for 1.5, and let's say a buyer's coming along who's putting 20%, if the buyer takes current market rate, this is what their payment's going to be on your home. However, if you were to give them X amount of dollars in credit, this is what their payment would look like in year 1 and year 2. And I show the seller the $10,000 payment versus the $8,000 payment in year 1 with their credit, and how much more attractive that is to a potential home buyer. And then I turn around and show the seller, okay, if you don't give the credit to, if you're not willing at this point to give the credit, just keep in mind that in order for that buyer to get that same payment on that 2-1 buy down, here's how much you would have to reduce the price on your home to get the equivalent payment. And it's like $150,000, $60,000 price drop. So essentially then what we end up saying is, look, you don't have to do anything, but just see it from your opponent's point of view, right? I mean, really, buyer against seller is, do you want to give up $19,000 to buy down the rate, or $150,000 chasing the market down if that's what ends up, happening, right? Those are just, this might be a little bit of an extreme example, but those are the, the numbers that play out.
Right. That's interesting. Very interesting. So, and thank you for clarifying that. But how long do you think we're going to continue to see these buy downs?
You know what? I think here's what's going to happen. I think that the interest rate drop that's happening is just happening very slow, and that's because inflation is slowly coming down. And in fact, we have a consumer price index inflation reading that's coming out tomorrow, and it very well could make it look like inflation is on the rise. And that's because inflation readings that come out are a year-over-year comparison. So we're looking back at March of 22 versus March of 23, and in March of 22, there was a dramatic drop. So it'll skew the reading, and I will not be surprised if the media, picks up on this and skews it. Oh, inflation's on the rise. Feds need to raise again. Like, they don't have inflation under control. But what I think is going to be ultra critical is not tomorrow, but on May 10th. May 10th to me, and I've been seeing this since October of last year, May 10th is such a critical inflation reading because, again, the inflation readings are year-over-year comparisons. And think about it like a roller coaster. So the data is lagging. So
Yeah.
what's been happening since, so on March 7th of 2022, that's the first day in 2022 where there was a big jump in rate in one day. And then throughout the year, there was a lot of volatility, and there was a few times that year where literally the rates increased like 0.5%, if not more, in one day. One day. Okay. So finally, the housing market stopped going like this. It was on fire, right? And it tapered off. And we saw the peak of the housing market in 22. And what, shelter inflation is a big component of the inflation reading that so far in every reading in 2023, because it's trailing 12 months, housing prices were still going like this. But once the interest rate increases started happening in March, housing started trickling off this roller coaster and started slowly going back down the other side or leveling off, depending on the market, et cetera, right? But that has not reflected in the data yet. But on May 10th, we will then see the year-over-year comparison after we started having rate increases in 22 for price start to level off. And I think because it's such a large percentage of the inflation, that shelter inflation number, that's when you'll start to see interest rates really start getting traction. Now, I'm not saying they're going to plummet in May. Really saying that will be the catalyst where I believe rallies the interest rate market through the end of the year. Now, there are other components, right? Like OPEC recently, said they were going to cut production of oil. That will have inflation issues globally. That will, be a challenge. But I do think that inflation comes down through the end of the year. I think we get closer back to a 3% inflation rate, and mortgage rates are always going to follow inflation. So I think people believe that the Fed hiking rates is increasing interest rates, and that's not true. It's inflation that's making it go up. When inflation goes up, rates go up. When inflation goes down, rates go down. So the Fed they're doing these rate hikes to purposely slow down the economy, which then trying to reduce inflation and bring rates down. Yeah.
Interesting. So let's just for a moment talk a little bit about the jumbo products. What are the jumbo products looking like these days?
Yeah, so what I've seen in the jumbo market that's pulled back is the low down payment jumbo product. For a while there was a very aggressive, and what I thought was a very aggressive interest rate or terms available for like I'm buying a $1.8 million home and I'm putting 10% down, right? But what we've seen is, especially with some of the banking issues that we've had recently, essentially jumbo lenders said, look, we're not willing to take that chance. And I don't think they're worried about defaults on the loans, because typically they'll put a guideline in place that requires the borrower to have a substantial amount of payment reserves anyway. So I don't think they're worried about default more than they're worried about, okay, do we really want to take the chance if the market corrects just 5%? Now, instead of at a 90% loan to value, we're at 95. And if that homeowner needs to sell, and by the time, they have selling expenses, they might be close to 100%, right? Yeah. And they learned their last time. And, the jumbo lenders are more, because most of them are money center banks. And so, or regional banks, they're heavily regulated. And so, they just don't want to take that chance anymore. So now what are you seeing? You're seeing there are the two, affordability solutions with a 2-1 buy down. Not every jumbo lender will offer it. There are a handful that do. So still available in the jumbo space. Interest only is becoming, more and more requested again. 40-year term is available, but not many people ask about it. Interest only is the one that really has big monthly savings. Yeah. Especially for someone who's putting a very low, like if a client's buying for 2-3. Yeah. And let's say they're putting $1 million down. If you go interest only on that scenario, you're probably saving $1,000 a month in payment, if not more. And so, if you've already got $1 million in equity, unless you really want to drive the principal balance down, a lot of people are, I'm fine with the interest only and making it more affordable. And remember, these interest only loans don't have prepayment penalties. So if you're self-employed and you want to chunk down $30,000-$40,000 on the principal, but at your discretion when you're ready,
Yeah.
the interest only loan provides a low carrying cost, but still the flexibility at your discretion to chunk down the principal, so you don't feel like, okay, well, I'm only paying principal and I'm not paying it down.
Interesting. So moving into the investor world, these investors, I'm talking the non-owner occupied investors. I'm seeing a very interesting dynamic where, because the interest rates are higher, and I think you and I spoke with a client recently who had great credit, had great money, reserves, all the whole nine, but in the property, when you flush out the numbers, the cap rate looked good, but if you're financing, then that interest rate has a huge impact on whether or not that cap rate is even realistic or achievable. So in that particular scenario, what we saw was the lender, and at that time this was a Citibank product, and they were charging a discount points. And I want you to explain, most people don't even realize what that discount point really means.
Yeah.
And you got the interest rate, and then you got the discount point, and then you have the fact that you've got investment, rental income that needs to be flushed out. So I want you to cover that whole scenario, because this particular client had no idea what that impact of those discount points. So I want you to talk a little bit about what that means, what that looks like, and how it affects borrowers.
Yeah, this topic of the conversation is spot on with what I said earlier about education, right?
Yeah.
Because there's so many things on the real estate side and on the financing side that are just looked at face value, and sometimes someone's not going deeper and missed. So first of all, let's talk about what a discount point is and why you're seeing a lot of that out there right now from a lot of lenders, even lenders that we have.
Yeah.
Okay, so first of all, a discount point is a one-time fee that a homeowner is choosing to pay to the lender in exchange for a particular interest rate. Okay, so in essence, if the rate today is 6% and you want 5%, then you need to pay a one-time fee to the lender to get 5%. Okay, but in the case you're referring to, this particular borrower, an investment property, multi-unit, essentially Citibank was saying, look, not only is the rate 3.75 or something, but on top of that, we're going to charge you, you don't have a choice to get that rate. First of all, you don't qualify at a higher rate. This is the best we can do is 7.375. And it was like 2 points or 2.5 points. Now, if the loan amount is, $1 million, you're talking about 2 points being 2% of the loan. That's $20,000, right? I think in this case, it was like, it was more than a point. It was almost like $30,000 in discount.
Yeah.
And so what I did is I said, okay, because we work with so many different lenders, again, some of our lenders do have discount points and some don't. And the reason that, first of all, you're seeing discount points is a lot of lenders are saying, look, we've been through this before. We know what's going to happen. When rates drop, what are you going to do? You're going to refinance. And we believe that's going to happen sooner rather than later. We're not going to hold this loan for the next 5 years. We're going to hold it for 5 months or a year, right? And then you're going to refinance. And when someone refinances that quickly, the lender loses their rate of return. So they know that, and so they're charging points up front to get a return because they know that loan's going to pay off their books. And so most of the time, that's why they're doing that. Either that, or again, with a Citibank, something like that, they can only have a certain percentage of their portfolio as investment property loans once it's considered high risk. So whether that be percent, et cetera. So they're almost in a way utilizing those points to discourage a client, if you will, or minimize, I shouldn't say discourage, minimize the exposure to their book of loans at the investment property scenario, right? They want more owner occupied, right?
Yeah.
So what I did is I went in and said, look, I get it that, you know, it's $30,000 for 7.375, but we have lenders that can go higher in rate, and hear me out. So if you show them 7.875, where the discount points are minimal, if not zero, okay? So now, again, you're going up in rate, but you're also going from a $30,000 discount out of pocket closing cost fee to zero. And obviously there's a trade-off. What's the trade-off? Higher rate, higher payment, but how much higher is the payment? And when you look at the payment, and it was $400 a month, I think it was, okay?
Yeah.
So if you believe, as you know, in this case, it was a very, very seasoned investor. So he had been through, I mean, longer than me, right? 30 plus years real estate investing. So he's seen rates at crazy percent, and you know, he's seen 2020 when they were 2.5. Right? He's seen it all. So I said, look, if you believe that inflation's going to drop and interest rates will then come back down, as they've done in history all the time, I'm not saying they're going to go back to 3%, but they're going to come back down. Yeah. Then, you know, let's pick a number. Let's say you believe that rates will drop in the next 12 months. So at $400 more a month in payment for the next 12 months, you're going to spend X amount of dollars, $5,000, whatever the number is, right? So you'll spend $5,000 more in payments, but you just saved yourself $30,000 at the closing. So your net savings, right? Yeah. Is 25,000, you know, I'm rounding these figures, but $25,000 in savings. So I think too many people get caught up in the transaction right then and there, the rate, the numbers. They're not looking at cost of ownership over the course of owning the property. Right. So we're trying to make it as most cost effective over time. So it makes complete sense to spend $5,000 more in mortgage payments for 12 months because you're saving $30,000 at the closing. Right. And then he agreed. Yeah. And then, you know, yeah, I'm going to spend $400 more a month, but then we're going to go back and refinance way lower than the, you know, he believes the 7.375 he's being offered from Citi. So now, you know, you save $25,000 and you're going to get the lower rate with no points in the future. Right. And both of those. Yeah, that's very education. You know, when we really have to keep our people educated, and not to me, even the loan officers, I hate to say this, but they had no explanation from the Citibank loan officer as to really what that breakdown, they had no clue. So it's really it's unfortunate to know that you've got, you know, mortgage professionals that are not really giving the client the full picture or the full, and maybe because they're not as educated on it themselves and they're just pushing the envelope along, right? It could be that they don't have the product. If you work for one lender, then you know you're kind of left, if you will, to do what you have. It could be both. You know, unfortunately in our industry, it is the epitome of, you know, 80-20 rule. You've got 20% of, you know, real estate agents and loan officers who are, you know, educating their clients and doing a bulk of the business. But the other 80%, you know, they're just going transactional case by case. And it's just, you know, it's a transaction. It's not a relationship. It's definitely not an education. There's no strategy. It's really just a reaction to what comes. You get a home inspection, let's react, right? You get test report, let's react. You get rates rise, let's react. and versus, okay, hey, you know, we're going to do this home inspection. The house was built in 1940. I'm telling you right now, things are going to come up, and
Sure.
you know, we're going to look at this, and we're going to get some contract bids. We're going to negotiate once we get there. You know, like you always do. Let me do my thing, and we'll guide you and walk you through it and take them through it. Versus, well, here's your home inspection. You know, I mean, I've seen some extreme examples where nothing is said. Just here's a copy.
Mm. Wow.
So, you know.
Well, I certainly am very appreciative of your, I call you the strategist because that's what you do with clients. And it's so critical, particularly when we're in environments like we are now. It's like you really need to think these things through, and you need to become educated. Is there anything else that I haven't covered that you think we might want to bring to surface here?
No, you know, the strategy and education is big. I think that's why we work so well together, because you've got your strategy and you know, we communicate a lot. So I think the whole loan officer agent relationship, a lot of those relationships today are just, you know, there's a certain dynamic there that, you know, is kind of, there's a stigma of that dynamic back and forth. And I think that's why we've worked together so well, because, you know, now we've done so many that you know, most of the time I'd like to think I know what you're thinking, but, you know, we focus on making sure the client's taken care of, and there's a lot to that. I would say that on this topic of education, the one thing that we have implemented that we started doing in 2022 is home buyer webinars, free home buyer webinars. And we don't call them first home buyer webinars because they're not just for first time buyers.
Right.
We do those on Wednesdays and Sundays, and it has had a tremendous impact. We've had people go transaction, close, and say, you know what? I cannot tell you how beneficial it was to having gone through the webinar prior to putting on a home, because, you know, we tell them, look, we base our entire model on how our team works based on the premise of, if someone is more educated on a topic, forget about loans, forget about real estate, just in general.
Yeah.
If they're educated on something, then ultimately it's going to lead to greater confidence. When they're more confident, then that's going to lead to success, right? And we define success as not just becoming a homeowner, but actually becoming a homeowner, but understanding what took place along the way, right?
Right.
The you know, just the lack of surprises. So when there are timelines or milestones of, okay, now it's your offer's accepted, there's seller disclosures, there's HOA docs, there's an escrow company, there's a deposit, there's an appraisal, you know, okay, you need to pay for the appraisal, or you need to pay for this, you know, inspection. These are not surprises anymore. So they're like, okay, I'm ready for this, right? And we've gotten so much great feedback about that. And so it's just another layer of the education that we've added on. And I think that's just, you know, it's just something that we really continue to.
Yeah, that's fantastic. What's the best way to reach you, Jason? What if someone wanted to reach out and get more information? How do we contact you?
Yeah, it can be by text. You can call me, email. Any of those is good.
Good. We'll put all of that information below. Everybody should be able to see it streaming. And I don't know. I just thank you for coming on. You know, there's a wealth of things that we can talk about. And I think education is key. And just working with a very seasoned professional who understands this inside and out, and also understands what's happening in the environment. So we really, really appreciate you.
I appreciate you. Thanks for having me.
Yeah. Thank you. Thank you so much.